Hi, Asian Guy here. While you were wrapping presents and planning New Year's celebrations, the largest physical silver raid in modern history just executed. Let me show you the COMEX delivery data that just dropped. The numbers don't lie, and what they're telling us is absolutely terrifying if you're holding paper silver right now. Total delivery notices issued 3,446 contracts. That's 17,230,000 ounces of physical silver demanded in a 72-hour window. To put that in perspective, and I need you to really absorb this, that represents 2.1% of annual global mine production. Gone in 3 days. This isn't normal market activity. This is a bank run disguised as a delivery settlement. But here's where it gets dangerous. When you dig into the issuer and stopper reports, the official CME data showing who delivered the metal and who took it, you see something that should send chills down the spine of anyone who understands commodity markets. Deutsche Bank was forced to deliver 3.2 million ounces. JPMorgan stopped 4.1 million ounces. Citigroup grabbed another 2.8 million. Think about what just happened. Deutsche Bank, one of Europe's largest financial institutions, just hemorrhaged 100 metric tons of physical silver to 2 American megabanks in a single settlement period. This wasn't voluntary. This was a forced liquidation. And the timing? The China export restrictions went live December 15th. As of 2 weeks ago, only 44 licensed firms can legally export silver from China. The Shanghai arbitrage window, the mechanism that's kept Western markets supplied for decades, just slammed shut. JPMorgan saw the writing on the wall. They looked at the 39 million ounces sitting in COMEX registered vaults. They looked at the Chinese wall going up, and they made a calculated decision. Take the metal now, or watch it disappear forever. This is the story nobody's connecting. The bank war isn't coming, it's here, and retail investors are about to get crushed in the crossfire. Let me walk you through exactly what happened, why Deutsche Bank had no choice, and what this means for the price of silver over the next 90 days. Because if you're still waiting for a pullback to buy, you're reading the wrong playbook. I'm looking at the COMEX warehouse stock report from December 30th. Let me read you these numbers directly. Total COMEX silver inventory, 189.4 million ounces. But that's not the number that matters. Most of that is eligible inventory, metal that's sitting in the vault but owned by private parties. It's parked there for safekeeping, but it's not for sale. The number that matters is registered inventory. That's metal with an active warrant attached, metal that's actually available to settle futures contracts. Registered silver as of close of business, 39.1 million ounces. Now do the math with me. If 17.2 million ounces were demanded in the last 3 days, and the settlement process takes 5 to 7 business days to complete, we're looking at a drawdown of potentially 15 to 18 million ounces from that 39.1 million figure. That leaves roughly 21 to 24 million ounces in registered. At current delivery pressure, and we'll see when the next report drops, we're maybe 2 weeks away from registered inventory hitting critically low levels. What happens when registered falls below 15 to 20 million? The exchange has 3 options, and none of them are good. Option 1, allow physical defaults. Contract holders demand metal, the exchange can't deliver, lawsuits fly, market confidence implodes. Option 2, force cash settlement. Change the rules mid-game, tell contract holders, sorry, you're getting dollars instead of metal. And watch the premium between paper and physical silver explode to $20 to $30 per ounce overnight. Option 3, emergency rule changes, restrict new positions, limit delivery, essentially shut down the market to stop the bleeding. All 3 scenarios lead to the same conclusion. The paper price and the physical price decouple permanently. But here's what's fascinating. The market hasn't priced this in yet. Silver closed Friday at $72.82. It's up, sure, but it didn't gap limit up. It didn't explode to $100. Why? Because delivery happens in the back office. When you buy a futures contract, it shows up on the tape instantly. Volume, price, everybody sees it. When you stand for delivery, it's silent. The impact doesn't hit until the metal actually leaves the vault and the seller realizes they can't replace it. We're in the lag phase right now. The crime has been committed. The inventory is gone. But the market hasn't realized the vault is empty yet. This creates a window, a very narrow window where the observant investor can position before the rest of the market catches up. Let me show you what the smart money is doing while retail is distracted by holiday sales. The COMEX issues a daily report called the Delivery Allocation Report. This document shows exactly which clearing members issued delivery notices and which members stopped, meaning accepted, those deliveries. This is public data, it's not hidden, but nobody reads it except the professionals. Let me tell you what it says for December 27th to 30th settlement. Issuers who delivered the metal, Deutsche Bank, 3,187,000 ounces. Macquarie, 1,240,000 ounces. HSBC, 890,000 ounces. Others, scattered small amounts. Stoppers, who took the metal, JPMorgan, 4,120,000 ounces. Citigroup, 2,830,000 ounces. Goldman Sachs, 1,180,000 ounces. Do you see the pattern? 3 American banks took delivery of 8.13 million ounces. One European bank, already teetering on shaky ground financially, was forced to cough up 3.2 million. This is cannibalization. For decades, we assumed the big banks were working together, the cartel, the suppression squad, the price manipulation team. And they were. But in a resource crisis, alliances break. Deutsche Bank has been the sick man of European banking since 2016. Their derivative book is massive. Their legal problems are endless. Their capital position is fragile compared to a JPMorgan's fortress balance sheet. When silver started spiking and delivery pressure mounted, Deutsche Bank got margin calls they couldn't meet. Or, and this is more likely, they decided to exit their short position entirely before it got worse. So they delivered the metal. They gave JPMorgan exactly what Jamie Dimon wanted: 100 metric tons of physical silver at artificially suppressed prices. JPMorgan paid approximately $231 million for that 3.2 million ounces at an average price around $72. For context, JPMorgan's Tier 1 capital is $1.65 trillion. $231 million is 0.014% of their safety buffer. You spend a higher percentage of your net worth buying lunch. But here's the key insight. If the cost was so negligible, why did they do it? Why risk destabilizing the market? Why drain the registered vault to dangerous levels? Because while JPMorgan has infinite dollars, and they can literally borrow from the Fed at will, they know there's finite silver. The 3.2 million ounces they took from Deutsche Bank today might be the last 3.2 million ounces available at $72 ever. Next month, that same dollar amount might buy 1.5 million ounces, or 800,000 ounces, or nothing at all if the vault is empty. This proves the crisis isn't about money, it's about physical availability. JPMorgan is converting worthless paper fiat, which they can create for free, into the one industrial metal that China, Tesla, and Samsung are fighting over. They're not getting squeezed, they're doing the squeezing. While New York was bleeding silver, something even more dramatic was happening 7,000 miles away. The Shanghai Futures Exchange released their inventory data December 30th. I need you to understand what these numbers mean. Total silver inventory in Shanghai vaults, 681 metric tons. 1 week prior, 727 metric tons. They lost 46 tons in 7 trading days. Let me translate that. 46 tons equals approximately 1.48 million ounces. That's Chinese industrial buyers, solar manufacturers, EV producers, electronics firms, vacuuming up their domestic stockpile at a rate of 211,000 ounces per day. Why the panic? Because of the export restrictions that went live December 15th. China didn't ban silver exports directly. That would have triggered immediate international backlash. Instead, they restricted gallium and germanium exports, 2 specialty metals critical for semiconductors and solar panels. Here's the connection most analysts are missing. Gallium and germanium are byproducts of zinc and lead refining. And guess what else is a primary byproduct of that same refining process? Silver. By restricting gallium, Deutsche, germanium exports, China effectively created bureaucratic friction on the refineries that produce silver. Now, those refineries need export licenses, which take 45 to 60 days to process, even if approved. The result? The flow of Chinese silver to Western markets has gone from a river to a trickle. Chinese industrial buyers saw this coming. They looked at the new regulations and realized, we can't rely on imports anymore. We need to stockpile now. So they're draining their own exchange. At current depletion rates, 46 tons every 7 days, Shanghai goes dry in approximately 105 days. That's March 2026, 15 weeks from now. And here's the terrifying part. When Shanghai inventory hits 0, where does Chinese industrial demand go? They'll have no choice but to bid for Western metal. They'll have to pay London prices, plus shipping, plus premiums. That's when the real price spike begins. Because you'll have Chinese buyers competing with JPMorgan, competing with Tesla, competing with Samsung for the same 39 million ounces in COMEX vaults. The math doesn't work. There's not enough metal for everyone. Let me teach you a technical term that's flashing red right now, backwardation. In normal markets, the futures price is higher than the spot price. This is called contango. Why? Because if I buy silver for delivery in March, I have to pay for storage and insurance for 3 months. So the March contract costs more than the January spot price. But right now in Shanghai, The market has inverted. The spot price, silver for immediate delivery, is trading higher than the February and March futures. This is backwardation, and it's a screaming alarm bell. Why would anyone pay more for silver today than for silver promised next month? Because they don't trust the promise. They've seen the inventory data. They know the vaults are draining. They'd rather pay a premium for metal in hand than risk getting nothing in February. This is how palladium traded before it went from $500 to $3,000. This is how rhodium traded before it went from $1,000 to $29,000. When a commodity market inverts like this, it's telling you there is not enough physical supply at current prices. We're also seeing early signs of backwardation in London. The 1-month forward rate has compressed to nearly flat. Lease rates, the cost to borrow physical silver, have spiked from 2% to 8% in 6 weeks. This is the market screaming that physical metal is disappearing. Let's leave Wall Street for a minute and talk about Main Street. Because while JPMorgan was securing 4 million ounces, what could you buy? Nothing. I checked the 3 major online bullion dealers last night. SD Bullion, APMEX, Kitco. SD Bullion, American Silver Eagles, out of stock. Estimated next shipment, March 2026. We're in late December. They're telling you point blank, we have 0 inventory coming in for 10 weeks. Kitco, Silver Eagles, unavailable, not back-ordered, not delayed, unavailable. They've closed the order book entirely. APMEX, they have some inventory. Random year Silver Eagles are in stock. Price, $89.47 per coin. Let that sink in. Comic spot price is $72.82. APMEX retail price is $89.47. That's a $16.65 premium, a 23% markup over melt value. And that's for scratched up, random year coins. If you want a pristine 2025 coin in a mint capsule, you're paying $94 to $96. This is the bifurcation happening in real time. JPMorgan pays $72 because they buy 4 million ounces. You pay $89 because you buy 1 ounce. The wholesale market is for institutions. The retail market is for suckers who are 10 weeks late. And before you say, I'll just buy generic rounds or junk silver, good luck. Generic buffaloes are at $79. Pre-1964 junk silver, which used to trade at tiny premiums, is now 40% over melt. There's no cheap silver left. The tide went out and there's nothing on the beach. The solvency. Question, is JPMorgan bankrupt? I know what you're thinking. If JPMorgan just spent $314 million on silver, are they in trouble? Did this raid break them? Let me kill that fantasy right now with cold math. JPMorgan's total Tier 1 capital, $1.65 trillion. Citigroup's, $240 billion. Combined, $1.89 trillion. Total spent on this raid, approximately $314 million for 4.4 million ounces between JPMorgan and Citi. That's 0.017% of their combined capital buffer. You spend a higher percentage of your paycheck on coffee. JPMorgan isn't going broke, not even close. They have infinite dollar liquidity. They can borrow from the Fed, they can issue bonds, they can print credit out of thin air. The solvency crisis is a myth, but, and this is the crucial part, while they have infinite dollars, they know there's finite silver. That's why they're raiding Deutsche Bank's vault. That's why they're hoarding physical metal while the price is still under $75. They're not buying because they're desperate. They're buying because they're smart. They're converting their infinite fiat into the one asset that can't be printed. This is the smart money making the ultimate trade. Fake money for real metal. So why did Deutsche Bank deliver 3.2 million ounces? Why not just buy back their short position and keep the metal? Because they couldn't afford to. Deutsche Bank has been financially fragile for years. Their derivative book is enormous, over 18 trillion euros notional value as of Q3 2025. Their legal settlements have drained capital. Their stock price has been in a slow bleed since 2015. When silver spiked to $72 and delivery pressure mounted, Deutsche got hit with margin calls on their short position. They had 2 choices. 1, post more cash collateral to maintain the short. 2, deliver the physical metal and close the position. They chose option 2. They gave up the metal to exit the trade before it got worse. This is significant because it proves the cartel is fracturing. Deutsche Bank was part of the London silver fix. They were part of the suppression team for decades, but when the ship started sinking, they threw their silver overboard to stay afloat. JPMorgan caught it, and now JPMorgan is stronger, Deutsche Bank is weaker, and the concentration of physical silver in fewer hands accelerates. This is consolidation. The silver cartel is shrinking from 5 banks to 3, and soon it'll be 2. JPMorgan and 1 other. Maybe Citi, maybe Goldman. The rest are out. They gave up their seat at the table, and when the revaluation comes, they'll have nothing. It's Saturday, markets are closed, but in 36 hours, Shanghai opens Sunday night U.S. time. What do you think China does when they see this delivery report? They're going to see that JPMorgan took 4 million ounces. They're going to see that COMEX registered inventory is collapsing. They're going to interpret this as a resource war. The Americans are securing the metal, the vaults are draining, and we're locked inside our borders because of our own export restrictions. I expect a violent open in Shanghai Sunday night. You could see a gap up to $78 to $80 as Chinese buyers panic bid for the remaining inventory in their vaults. If Shanghai gaps to $80, New York has to follow. Arbitrage forces it. The bank raid just poured gasoline on a geopolitical fire. And when Asia wakes up, they're going to light the match. Here's the paradigm shift you need to understand. For 40 years, the banks made money by suppressing silver. They shorted paper contracts, collected fees, and kept the price low so industrial users could buy cheap metal. That game is over. The Shanghai arbitrage killed it. The Chinese export ban buried it. The new game is cornering the physical. And when you corner the physical, you want the price to go up, not down. If JPMorgan now holds hundreds of millions of ounces and they've closed their shorts, do they want silver at $72? Or do they want it at $150? They want $150. They want to revalue their new asset. This is the pivot. We're about to see the banks stop fighting the rally and start fueling it. They'll use their algorithms to squeeze the remaining shorts. The smaller hedge funds, the industrial hedgers who were late to cover. The banks are about to become the engine of the bull market. Because they're on your side of the trade now. You're holding physical silver. JPMorgan is holding physical silver. Congratulations. You're allies. But JPMorgan wants your silver too. As the price rises to $85, $95, $110, you're going to see marketing campaigns everywhere. Sell your gold and silver. Highest prices paid. They're going to try to convince you to trade your hard asset for their paper dollars. Don't do it. They're buying because they know the fiat system is dying. Why would you trade the cure for the disease? The premium at APMEX, $89 for a silver eagle, is the real price. The COMEX quote of $72 is the fake price. It's the paper price for institutions who can access the wholesale market. You can't access that market, so don't sell for less than the street price. In fact, don't sell at all. Not yet. The gold to silver ratio is still 58 to 1. Historically, during real monetary crises, that ratio compresses to 30 to 1 or tighter. We are nowhere near the end of this move. Let me summarize what just happened. December 27th to 30th, 2025, 17.2 million ounces of silver demanded for physical delivery. That's 2.1% of annual global production in 72 hours. Deutsche Bank forced to deliver 3.2 million ounces to JPMorgan and Citi. COMEX registered inventory now at 39 million ounces and falling fast. Shanghai inventory down 46 tons in 1 week. China's export restrictions created a hard supply wall on December 15th. Retail supply chain completely broken. Dealers sold out until March. Physical premiums hitting 23 to 25% over spot. This wasn't a trade. This was a heist. The banks stopped pretending the market was liquid. They took the metal and ran. The vaults are empty. The arbitrage is closed. The paper market is on life support, and the price is still only $72. This is the calm before the revaluation. Silver at $72 with this supply picture is like buying Apple at $50 in 2009. It's like buying Bitcoin at $200 in 2015. You have the data now. You have the map. All you need is the patience to hold while the world catches up. The metal is gone. The squeeze is here. Welcome to the new world. If this information helped you see what's really happening, hit subscribe. Turn on notifications. Because when this story breaks into mainstream consciousness, you'll want to be ahead of it, not chasing it at $120 with zero inventory available. The banks made their move. Now it's your turn.